Hey, it is Deep Dive with Daniel time. I'm Darren Harper, your host. And Daniel, which is across the seas, is going to bring us some information about this little yellow bird. Yellow bird. It's a canary. And you may have heard the term a canary in a coal mine. And we're going to dig into that and kind of tie it in with U.S. Treasuries. And his blog is titled Blonde, Blondes Don't Lie? No, Bond Yields Don't Lie. Why Treasuries might be the market's real canary in the coal mine. And I just, every time I hear this, I want to say bond, Treasury bond. Okay, so you got that. All right, good. Movie people will get that. All right, so let's jump in here. So you started it off talking about, all the things that have been in the news, which is, AI, stock rallies, political chaos, blah, blah, blah. But you're saying this really is the thing that's quiet, but really should be the loudest. Is that what you're saying about bond yields and bonds and treasury bonds and other countries buying bonds, etc.?
Yeah, Darren, do you know why they used to carry a canary into a coal mine?
I've heard it, but I've forgotten since.
So they used to carry it in because I guess they're like more sensitive to the gases that could be in a coal mine. So essentially it would die before the humans would die. So they would carry it. And if the bird like passed out, they'd be like, all right, it's time to turn around.
Ah, that's so sad. But I guess it saves humans.
Well, I mean, you get people when
Laboratory.
there's like 50 dudes in a coal mine, one little bird.
Of course,
Um,
me. I have an affection for the little yellow bird, though. But all right, go
But
ahead.
when you look at bonds as the little yellow bird, it can be the sign that things are about to change, right? Because when you think of bonds, bonds are sensitive to the most kind of like immediate macro tells in the market of what's going to come, where the stock market is delayed a little bit, right? Because bonds get affected by, like you said, you know, how much governments are buying bonds from another country, how interest rates are moving, which in turn affect, corporate interest rates, like money market funds, mortgage-backed securities, like all those kinds of things that actually do affect how people move, lend, and like manipulate money like around the world.
Right. And it affects a lot of different things that you don't think it affects. So, and I think that's why we always hear about, at least in the news, they say that the financial news, they say that the 10-year bond is the one that everybody should look at, and that's the true temperature of what's going on. And we also know that the stock market itself likes to run ahead of what's going on. So that's kind of a back and forth thing there, because if the stock is trying, it's not doing what's happening today, it's what it thinks is going to happen down the road. But we always seem to be pushing it towards what is positive and nothing negative, and just skipping over the negative things here lately. So you're saying now that the yield is up near what, 4.5? I think 4.5, the 10 year.
10 years, 4.39 right now.
Oh, it fell a little bit more. Okay.
Yep.
Yes, yeah. Yesterday, I think it was about 4.48 or something like. I don't remember. I feel like it did fall down.
Yeah, it's fallen
Then
about 20 basis points
okay,
since kind of the end of May.
gotcha.
And that was
So
after that huge spike of, people freaking out.
yeah, a little bitty war happening and stuff like that, and just
Mhm.
our debt that just won't stop. I think the debt is the biggest reason, but go ahead and talk about why the 10 years the most important. Is there a reason why the 10 year?
Yeah, it's just kind of like a medium term gauge, right? So like
Okay,
we issue bonds all the way out to 30 years, and then we have treasuries that are a few months short.
right,
So it's just kind of like the middle point of
gotcha.
looking where bonds sit. Now the important thing to like note now is that the 10-year actually has, let me see if I can, like a lower year than like some of the monthly treasury bills. So the like not like the not the 10 minus the 2, but the yield curve is like ever so slightly are almost inverted, right? So when you look at it, it kind of goes like this, and then the 10-year, but then long duration bonds are still have higher yields than the short ones, which is good. That's what you want, right? You don't want what would be called contango. That being said, for a long time, that was not true. And the 10-year, if you do the famous 10-year minus 2-year, we were inverted for quite a while. And we're, coming up on that time of reckoning after it reverts back to positive.
Yeah, you keep mentioning that and saying, I said it X amount of months ago. So yeah, we're kind of in that sweet spot almost, which is almost why I kept saying June, because it was about a bond thing. It wasn't about anything else other than a bunch of bonds being due. So and then having to refinance at a higher rate, which is not good either. And then you add in this huge debt that the country keeps having, and this big beautiful bill is not going to help any. It's a recipe. So you have some
How much
traditional
is the bill
historic.
for? Five trillion?
I feel like it was five, maybe at least. Um, the Yeah, I think it was around five. From what I remember. So you were talking about the 10-year or when bonds called historically some things that have happened. So what are those historic moments that weren't
Yep.
good?
So yield curves inverted right before '08 happened, right? So that was a thing where people are over leveraged. They had to cut rates very drastically. We had the summer going into 2019, right before, kind of COVID happened. And then there was March 2023, which was actually, I think, is that date right? Collapse of Silicon Valley Bank. I can't remember, so long ago at this point.
Yeah.
But that was one of those things where bonds had started, or sorry, banks had started to buy bonds when they started actually having like a decent interest rate, and everyone looked at the bank's balance sheet and go like, oh, their unrealized losses are insane, like these banks are insolvent. um,
Mhm.
and people started freaking out and taking money out. Now the important thing to remember about that is that, one, certain banks are forced to buy US Treasuries, right? It's part of like how the system works.
Well, they have a
Um,
percentage they have to hit, right?
yeah, like they have to own a
60,
certain amount,
40 or something like that.
and then like at bond auctions, like they kind of have to be there to buy some because they like kind of provide, like not everyone's buying from a bond auction, right? They're often bought after the fact.
Mhm.
Um, as well as if you hold the bond forever, you don't lose money. You might lose money in real terms against inflation and like opportunity cost of holding something
Yeah.
else, but like it's an unrealized loss unless they sell right now, then it would be a real loss, but it's not until later. Obviously the concerning part is other banks, like maybe Bank of America, of how big that unrealized loss is and how long they have to hold those bonds. But it was some tweets with some people who didn't understand how it truly worked that caused Silicon Valley Bank to collapse, which was pretty wild. But I
Yeah,
digress.
that is wild. So then you moved on to the next part of yours, which is talking about the multi-year highs, multi-decade highs, excuse me, and that's not normal. So we're not in a normal time right now, which we know that just because of everything that's happening. And you mentioned just quickly foreign selling pressure, which we've seen that, um, the ballooning U.S. deficit, credit rating risks, and political risk. Um, which he wants midterms to happen, right? And he doesn't want anything to blow up
Mhm.
until after that, I guess. So he's kind of stuck right here, and that's kind of why I feel like we're just kind of sticking right here and just staying in this little channel until something forces it to blow up. So I think you guys have started to call September, and then I said, of course, this month, which we're running out of days. Um, Maybe it's going to be in between, somewhere in July or August. Who knows? So, I mean, we can all agree that we think it's in the next 4 months, or the next quarter, if you will. Um, so the average investor, though, let's just say I'm Joe Blow, who every day I have my own special company stocks, etc. Why should I care anything about Treasury bonds?
Yeah, I mean, like we talked about in the beginning, is that the treasury rates do affect, kind of real world products, right? So it makes treasury rates are the basis for loans. So whether that's mortgages or car loans, so it makes your mortgage payment more expensive, your car payment more expensive. It changes how people invest in the stock market, right? So rates are really low, people borrow more money, people put more money into the stock market, stocks go higher, right? Everybody loves that if they're invested, right? Rates go really high, people don't borrow as much money, stocks don't move as much. People don't like that who are invested. And then also, when rates do go up, the requirement to draw that capital increases. So banks give out less loans, right? They're tighter on capital. They control their risk more, if you will. And that makes it, the average person who needs a loan, whether that's for that mortgage or car, for their business, personal needs, whatever, makes things difficult. And then also for people that are invested in bonds, it can drastically change. Like bonds are often thought as the safe haven, but if U.S. Debt, spikes and we get downgraded again, yields will go drastically up, which results in prices going down. So if you're not planning on holding your bonds to duration, you now have to take a loss on them.
And people, won't they come out of stocks and go into those high yields to try to get a high rate?
Yeah. Yep.
Yeah. So it's always been
Assuming their stocks aren't down more.
well. Yeah. True.
So
Yeah.
it's a bit
So
of
I
a
mean,
balancing act.
it's exactly it's back and forth, back and forth. So that's when people say they're in cash versus in stocks. So it'll be interesting to see. Like I said, I think we've kind of narrowed it down to here these next 3 months that we've been saying popcorn and Coke time to watch and see what happens. But at least now I think we're in that 90-day window where something has to give here.
Mhm.
So I think you put it perfectly at the end. You said, in a world of noise, bonds whisper the truth, and right now they're starting to raise their voice. So we've been raising our voice for a bit. We were
Yeah.
ahead of the bonds. So
We've definitely
all right,
called the last 12 bear markets of the last two.
that's right. All right, appreciate it. We'll see what happens here. Just tune in next week, see what Daniel brings us in the world of finance. And thanks for joining us, Daniel.
See you next time, Darren.
All right, bye.